In the spring of 1933, American families were losing their homes at a rate approaching 1,000 a day. The crisis was not confined to reckless speculators or wealthy investors. It reached factory workers, shopkeepers, farmers, and clerks, people who had made every payment they could until unemployment, bank failures, and collapsing wages made repayment impossible. By then, roughly half of all residential mortgages in the United States were in default. Banks were failing under the weight of bad loans. Families who had spent years making payments discovered that they had built little or no ownership in the houses they occupied. The American housing system was disintegrating. What made the collapse so destructive was not simply the scale of the Great Depression. It was the design of the mortgage itself. Before the 1930s, most home loans were short, unstable, and structured around a final payment few borrowers could afford. The 30-year fixed-rate mortgage, now treated as a normal part of American life, did not yet exist in recognizable form. For most of the country's history, ordinary people did not buy homes by walking into a bank, making a modest down payment, and repaying the balance over decades. They needed substantial wealth, access to a cooperative lending institution, or the willingness to gamble their future on a loan that could be withdrawn after only a few years. To understand why Washington eventually rebuilt the system, the story begins long before the modern bank mortgage, at a time when the federal government itself was the largest landholder in the nation. After the Revolutionary War, the United States controlled immense territories beyond the original states. These lands represented revenue, political influence, and the possibility of national expansion. But distributing them raised a fundamental question. Would Western land be sold to wealthy investors in large blocks, or open to ordinary settlers? The Land Ordinance of 1785 created a standardized survey system. Public territory would be divided into square townships measuring 6 miles on each side. Each township would contain 36 sections, with a full section covering 640 acres. The grid imposed order on land that federal officials often knew only through maps and surveys. It would shape the geography of much of the American Midwest and West, but the system did not make land affordable. A 640-acre parcel was far beyond the needs and finances of most working families. Congress later reduced the minimum purchase size by 1800. Buyers could acquire 320 acres and pay in installments. Yet at $1.25 an acre, even the smaller tract required hundreds of dollars at a time when most workers earned only a fraction of that amount. The policy favored speculators. Investors with capital bought large parcels, held them while settlement increased their value, and resold smaller portions at a profit. Families who actually cleared the forests and cultivated the soil often entered the process later and on less favorable terms. Many settlers avoided the official system entirely. They moved onto unsurveyed or unclaimed land, built cabins, planted crops, and attempted to establish possession before legal title existed. These squatters hoped that occupation and improvement would eventually persuade the government to recognize their claims. For them, ownership did not begin with a loan document, it began with physical occupation and risk. That pattern changed dramatically during the Civil War. In 1862, with many Southern opponents of free land legislation absent from Congress, President Abraham Lincoln signed the Homestead Act. The law offered up to 160 acres of public land to adult citizens and those who had declared an intention to become citizens. Claimants paid a small filing fee, lived on the property, improved it, and cultivated it for 5 years. After meeting the requirements, they could receive legal title. The program became one of the largest transfers of public land into private ownership in American history. Between 1862 and 1976, more than 270 million acres were distributed across 30 states. Over 2 million claims were filed, and more than 900,000 ultimately resulted in land patents. The Homestead Act helped populate the Great Plains and the West. It supported farms, towns, and rail connections across regions that the federal government wanted settled and economically integrated. But it did not solve the emerging urban housing problem. During the late 19th century, America was becoming an industrial society. Millions of people moved towards cities in search of wages. Immigrants arriving from overseas joined rural Americans leaving farms for factories, stockyards, mines, and workshops. These families did not need 160 acres on the plains. They needed a house near employment. In New York, Boston, Philadelphia, Cleveland, Chicago, and other growing cities, land prices rose as populations expanded. Tenements, boarding houses, and crowded rental buildings became the normal environment for much of the industrial workforce. Buying a home required money most workers did not possess. One option was to pay cash. That placed ownership largely beyond the reach of wage earners. The other option was an early mortgage, although the word suggested more security than the product provided. Around the beginning of the 20th century, a lender might finance only half of a property's price. A buyer therefore needed a down payment of 50%, sometimes more. For a house costing $4,000, the buyer could be required to produce $2,000 in cash. An American worker earning roughly $400 or $500 a year could not save that amount without years of extraordinary sacrifice. Rent, food, clothing, illness, and family responsibilities made the calculation nearly impossible. Even a household that assembled the down payment faced a dangerous loan structure. Mortgages commonly lasted 3 to 5 years. Some extended longer, but long-term financing was unusual. During the life of the loan, borrowers often paid only interest. The principal, the amount originally borrowed, did not decline. At the end of the term, the entire balance became due. This balloon payment transformed the mortgage into a recurring test of survival. A family might make every scheduled interest payment and still owe nearly the original loan amount several years later. Most borrowers expected to refinance. They would approach the same lender or find another institution willing to issue a new short-term mortgage. As long as credit remained available and property values held steady, the process could continue. But the borrower never possessed certainty. A bank could refuse to renew. Interest rates could rise. The value of the house could fall. A local financial panic could eliminate available credit. If refinancing failed, the borrower needed to produce the entire balance or surrender the property. Homeownership under this arrangement was provisional. The family occupied the house, maintained it, and carried the emotional burden of ownership without receiving the stability later generations would associate with a mortgage. One type of institution offered a more workable alternative. Building and loan associations emerged from local cooperation rather than conventional banking. The Oxford Provident Building Association, founded in 1831 near Philadelphia, is generally recognized as the first of its kind in the United States. Its structure was based on pooled savings. Members purchased shares and contributed money into a common fund. As the fund grew, participants could borrow from it to buy or construct homes. Loan repayments returned money to the pool, allowing other members to borrow in turn. The model treated borrowers and savers as part of the same community. Members were not merely customers of a distant bank. They were participants in an organization created to finance one another's homes. These associations filled a gap traditional banks often ignored. National banks faced restrictions on real estate lending, while many state-chartered banks regarded mortgages as too illiquid or risky. Building and loan associations specialized in precisely the borrowers the conventional system failed to serve. Their terms were also more humane. Loans might last 8, 10, or 12 years. Payments often included both interest and principal, a process known as amortization. Each payment therefore reduced the debt and increased the borrower's equity. This changed the meaning of the monthly payment. It was no longer merely the cost of keeping a short-term loan alive. It became measurable progress toward ownership. By the late 19th century, building and loan associations had spread throughout the country. They became especially important in working class and immigrant communities where conventional bank credit remained difficult to obtain. By 1930, they had approximately 12.3 million members and close to $9 billion in assets. They held roughly one-third of the home mortgage debt supplied through financial intermediaries. Their importance later entered American popular culture through the fictional Bailey Building and Loan in its A Wonderful Life. The film's conflict between a community lender and concentrated financial power reflected a reality familiar to millions of Americans. These institutions helped families buy homes. They did not make ownership universal. In 1900, only about 46.5% of American households owned the places where they lived. The rate declined slightly during the following 2 decades as urban populations increased and housing costs outpaced the ability of many workers to save. Then the 1920s changed the atmosphere. Economic growth, rising incomes, expanding credit, and widespread optimism pushed housing construction and mortgage borrowing upward. Residential mortgage debt tripled during the decade. Savings and loan associations financed millions of properties. Ownership rates rose toward 48% by 1930, but the expansion rested on fragile foundations. Short-term balloon mortgages remained common. Buyers increasingly combined first mortgages with second mortgages, land contracts, and other forms of debt. Some families financed a larger share of the purchase price than earlier borrowers had attempted. The system became a complicated web of short maturities, high interest costs, repeated refinancing, and overlapping claims on the same property. It worked while employment remained strong, banks remained open, and lenders continued to renew loans. Then the stock market crashed in October 1929. The economic contraction spread through every part of the financial system. Businesses failed, industrial production declined, wages fell, and unemployment eventually rose above 25%. Banks collapsed in waves. By 1933, more than 9,000 had closed. When banks disappeared, so did the credit homeowners needed to refinance balloon mortgages. A family might still have made every previous payment, but if the loan reached maturity during the crisis, there was often nowhere to obtain a replacement. Borrowers lost jobs and income. Property prices fell, refinancing vanished. The housing market entered a destructive cycle. Delusions damaged banks. Bank failures reduced the supply of credit. The lack of credit caused more defaults. Foreclosures pushed additional homes onto the market, lowering prices and weakening the value of the collateral behind surviving loans. By 1932, approximately 250,000 households had already lost their homes. In 1933, about half of all residential mortgages were reportedly in default. Building and loan associations suffered alongside commercial banks. Withdrawals increased as members desperately sought cash. Outside credit lines disappeared. Thousands of institutions closed or entered distress. The national homeownership rate fell toward 43.6% by 1940, its lowest recorded level of the period. The crisis revealed that the mortgage system had not merely failed individual borrowers. It had become a mechanism for transmitting financial collapse through the entire economy. President Herbert Hoover's administration made one of the first attempts to create a national support structure. The Federal Home Loan Bank Act of 1932 established a network of regional banks designed to provide liquidity to savings and loan institutions. Modeled partly on the Federal Reserve, the system was intended to help mortgage lenders obtain funds when private credit markets failed. It was an important reform, but the emergency was moving faster than the new institution could respond. When Franklin D. Roosevelt entered office in 1933, foreclosure had become a national political crisis. On April 13th, Roosevelt asked Congress to protect small homeowners. 2 months later, lawmakers created the Homeowners Loan Corporation. The HOLC did not simply give cash to borrowers. It purchased troubled mortgages from banks and other lenders, often exchanging government-backed bonds for loans already in default or foreclosure. It then rewrote those mortgages on terms families could realistically meet. Short balloon loans were converted into 15-year, fully amortizing mortgages. Interest rates were reduced to approximately 4.5%. Monthly payments now reduced both interest and principal. The difference was structural. Borrowers no longer faced a massive balance after a few years. If they made every payment, the debt would eventually disappear. By the time the HOLC stopped issuing new loans in 1936, it had refinanced more than 1 million mortgages worth over $3 billion. The program saved countless families from immediate foreclosure. More importantly, it proved that a long-term amortizing mortgage could stabilize borrowers, lenders, and the broader economy at the same time. But the HOLC was a rescue operation, not a permanent housing system. Washington had prevented part of the collapse. It had not yet created the financial machinery that would turn homeownership from a dangerous privilege into a mass middle-class expectation. That transformation would begin in 1934. In 1934, the federal government crossed a line that would permanently alter the relationship between Americans, banks, and the homes they lived in. The Homeowners Loan Corporation had already shown that long-term amortizing mortgages could rescue families from foreclosure. But the HOLC was temporary. It was designed to contain an emergency, not to finance the future. The deeper problem remained unresolved. Banks had been devastated by the Depression. Thousands had failed. Surviving lenders had watched property values collapse, and borrowers default in unprecedented numbers. Even families with steady incomes found it nearly impossible to obtain a mortgage, because the institutions holding capital no longer trusted the housing market. Credit had frozen. Without a permanent mechanism to reduce the danger of mortgage lending, the recovery of homeownership could stall for years. Congress responded with the National Housing Act of 1934, which created the Federal Housing Administration. The FHA did not primarily lend money to buyers, its power came from insurance. If a bank issued a mortgage that met federal standards and the borrower later defaulted, the government would protect the lender against much of the loss. That guarantee changed the calculation inside every participating bank. A mortgage was no longer simply a long-term gamble tied to one borrower and one property. It was a government-insured asset. but federal insurance came with conditions. The FHA demanded an entirely different kind of home loan from the short balloon mortgages that had dominated before the Depression. Terms became longer, down payments became smaller. Interest rates could be fixed. Most importantly, payments had to reduce the principal over time. The mortgage was transformed from a loan that repeatedly threatened the borrower with a final lump sum into a scheduled path toward full ownership. Early FHA-backed mortgages generally lasted 15 or 20 years. Maximum terms later extended to 25 and eventually 30 years. Congress authorized 30-year financing for new construction in 1948 and for existing homes in 1954. The 30-year term did not become dominant immediately, but the essential structure had been created in 1934. Every payment would cover interest and part of the debt itself. If the borrower continued paying, the balance would reach zero at a predictable date. That sounds ordinary now. At the time, it was a radical reorganization of risk. Borrowers gained stability. Banks gained federal protection. The government gained influence over the standards used to build, value, and finance American housing. The modern mortgage had been born, yet one major obstacle remained. A lender making a 20 or 30-year mortgage tied up capital for decades. A local savings institution could issue only as many loans as its deposits allowed. Once its money had been converted into mortgages, it might have to wait years for borrowers to repay enough principal before financing new buyers. Long-term loans solved the borrower's problem while creating a liquidity problem for the lender. In 1938, the federal government created the Federal National Mortgage Association, later known as Fannie Mae. Fannie Mae established a national secondary market for mortgages. Instead of holding every home loan until its final payment, a bank could sell an eligible mortgage to Fannie Mae. The lender received fresh capital and could immediately issue another loan. Fannie Mae could retain the mortgage or use broader financial markets to support further purchasing. This connected local housing credit to national pools of money. Before the secondary market, a savings and loan in Ohio depended heavily on deposits collected in its own community. Afterward, mortgage capital could move across state lines and regions. Savings from one part of the country could finance construction and home purchases somewhere else. The effect was similar to building financial infrastructure. Local markets that had once operated in relative isolation became parts of a national system. Mortgage lending could now continue even when individual institutions reached the limits of their own deposits. The Depression-era reforms had created the basic machinery, government insurance to reduce lender risk, standardized long-term loans to protect borrowers, and a secondary market to replenish mortgage capital. World War II would place that machinery under extraordinary pressure. During the war, civilian home construction slowed sharply as labor, materials, and industrial capacity were directed toward military production. At the same time, millions of servicemen and women were stationed away from home. When the war ended, returning veterans entered a country with severe housing shortages. They wanted employment, family life, and stability after years of disruption. For many, a home represented the clearest symbol of the peace they had fought to restore. The Servicemen's Readjustment Act of 1944, the GI Bill, helped turn that desire into purchasing power. Among its provisions were federal guarantees for veterans' home loans. Eligible borrowers could obtain favorable interest rates and, in many cases, purchase homes with little or no down payment. The guarantee opened the mortgage market to people who might otherwise have spent years accumulating savings. A returning veteran did not need to arrive with inherited wealth or a massive cash reserve. The federal government effectively stood behind the loan, reducing the lender's risk and making ownership possible much earlier in the borrower's life. By 1955, approximately 4.3 million home loans had been issued through the program with a combined face value of about $33 billion. Veterans purchased a substantial share of the homes built in the post-war years. Demand surged so rapidly that traditional construction methods struggled to keep pace. Builders responded by applying industrial techniques to housing. One of the most famous examples appeared on Long Island, where Levitt and Sons acquired thousands of acres of farmland and began constructing homes at extraordinary speed. Instead of assigning one team to build a house from beginning to end, the company divided construction into repeated specialized tasks. Crews moved from site to site performing the same operation, laying foundations, framing walls, installing plumbing, painting interiors. The process resembled an assembly line spread across a landscape. Standardized houses could be completed faster and sold at prices accessible to families using government-backed mortgages. Monthly housing costs could compete with urban rent. Levittown became a symbol of a national transformation across the country. Fields and undeveloped land were converted into subdivisions of detached houses with yards, driveways, and access to newly constructed roads. Retail centers, schools, and local services followed the population outward. The mortgage system did not merely finance homes, it reorganized metropolitan America. The scale of the change appears in the ownership figures. In 1940, only about 43.6% of American households owned their homes. By 1950, the rate had risen to approximately 55%. A decade later, it approached 62%. Within 20 years, the United States shifted from a country in which most families rented to one in which most owned. Several policies worked together to produce that result. FHA insurance encouraged banks to make longer loans. VA guarantees expanded access for veterans. Fannie Mae supported a continuous supply of mortgage capital. Fixed-rate amortization made payments predictable. Federal tax policy allowed many homeowners to deduct mortgage interest. A strong post-war economy supplied rising incomes, while mass construction increased the number of available houses. Homeownership became central to the American definition of middle-class security. A house provided shelter, but it also became a financial asset. Each mortgage payment built equity. As property values rose, families accumulated wealth that could later support education, business investment, retirement, or inheritance. For millions, the new mortgage system created an economic ladder, but access to that ladder was not equal. The same federal institutions that expanded ownership also helped construct a housing order divided by race. During the 1930s, the Homeowners Loan Corporation produced residential security maps for major American cities. Neighborhoods were classified according to their perceived lending risk and assigned colors. Areas considered strongest were marked green. Those judged most dangerous were marked red. The grades reflected more than the condition of buildings or the financial records of residents. Racial and ethnic composition played a major role. Neighborhoods with black residents, immigrants, or other minority populations were frequently treated as hazardous even when individual borrowers had stable incomes and histories of repayment. The term redlining emerged from these maps and the lending practices associated with them. The FHA reinforced segregation through its underwriting standards. Mortgages in predominantly black neighborhoods were often denied insurance. Federal policy also favored developments that maintained racial separation and treated integration as a threat to property values. Private banks followed the signals established by government agencies. If the FHA refused to insure loans in a neighborhood, lenders had little incentive to make them. Families living in redlined areas faced higher borrowing costs, exploitative contract arrangements, or complete exclusion from conventional credit. The GI Bill did not automatically overcome these barriers. Although the legislation was federal, its benefits were administered through local institutions operating within segregated housing and banking systems. Black veterans could possess the same formal eligibility as white veterans and still find that banks would not approve their loans, brokers would not show them properties, and developers would not sell to them. The disparity was severe. In 1947, only 2 of more than 200 VA guaranteed home loans issued across 13 Mississippi cities reportedly went to black borrowers. In the suburbs surrounding New York and northern New Jersey, fewer than 100 of roughly 67,000 mortgages insured through the GI Bill supported purchases by non-white families. Levittown itself excluded black buyers during its early development. The suburban expansion therefore operated as both a wealth-building program and a system of exclusion. White families gained access to affordable houses whose values often appreciated over decades. They accumulated equity, passed property to their children, and used housing wealth to finance further advancement. Many black families were confined to neighborhoods starved of conventional mortgage credit. They paid rent or entered predatory contracts while being denied access to the federally supported assets rising in value outside city centers. This did not merely produce different housing experiences. It created different financial futures. The modern racial wealth gap cannot be understood without this history. When one group received subsidized access to appreciating property and another was systematically obstructed, the effects compounded across generations. Housing wealth was inherited, so was exclusion from it. The system created in the 1930s and expanded after the war continued evolving. Fannie Mae was reorganized and Freddie Mac was later established to strengthen the secondary market. Mortgages became increasingly connected to global capital through securities backed by pools of home loans. The 30-year fixed-rate mortgage became a defining American product. Its structure is unusual by international standards. In many countries, borrowers receive shorter fixed-rate periods or loans whose interest rates reset regularly. A household might refinance every few years or remain exposed to changing market rates. The American borrower, by contrast, can often lock in one rate for 3 decades while retaining the option to refinance if rates fall. That asymmetry strongly favors the homeowner. If rates rise, the borrower keeps the old rate. If rates fall, the borrower may replace the loan. Such a product is difficult for private markets to sustain without the broader government-supported system that developed after the Depression. The 30-year mortgage, therefore, appears private at the moment of signing, but it rests on public architecture. Its stability depends on regulation, federal guarantees, central liquidity, standardized underwriting, and institutions capable of moving mortgage risk through capital markets. That architecture helped produce extraordinary prosperity. It also created new dangers. By the early 21st century, mortgage finance had become deeply entangled with complex securities. Banks and specialized lenders issued loans, combined them into pools, and sold financial claims tied to the borrower's payments. The ability to sell mortgages weakened the connection between the lender making the original decision and the investor ultimately carrying the risk. During the housing boom preceding 2008, underwriting standards deteriorated. Loans were extended to borrowers with limited ability to repay. Adjustable rates, low introductory payments, weak documentation, and speculative assumptions about ever-rising home prices spread through the market. Mortgages that appeared risky individually were packaged into securities and presented as diversified investments. The system depended on housing prices continuing upward and borrowers continuing to refinance. When prices stopped rising, defaults increased. Mortgage securities lost value. Banks and investors discovered that risks thought to have been distributed had instead become concentrated throughout the global financial system. Fannie Mae and Freddie Mac suffered enormous losses and entered federal conservatorship in September 2008. Institutions originally intended to stabilize mortgage finance had become central to another housing crisis. The episode did not erase the achievements of the post-Depression system. It demonstrated that those achievements were not self-sustaining. Long-term mortgages can protect families, but only when lending standards remain tied to the borrower's actual ability to repay. Secondary markets can expand credit, but they can also obscure responsibility. Government backing can prevent collapse, but it can encourage excessive risk when institutions assume rescue is guaranteed. Housing cannot be treated only as a financial instrument. A mortgage appears on a bank's balance sheet as an asset. To the borrower, it is a claim on the place where children sleep, families gather, and lives are built. That distinction explains why mortgage crises carry consequences beyond ordinary investment losses. The 30-year mortgage is often described as though it emerged naturally from competition among banks. It did not. It was created through federal intervention after private housing finance nearly collapsed. The government rescued failing loans, insured new mortgages, standardized amortization, guaranteed veterans borrowing, and constructed a national secondary market. The result transformed ownership from an option available largely to the wealthy into a realistic goal for millions of wage-earning families. It also helped segregate metropolitan America and distribute wealth along racial lines, whose effects remain visible. The system contains both histories. It expanded opportunity, but not equally. It produced stability, but not permanently. It allowed ordinary households to build wealth, while exposing the economy to enormous danger when housing finance became detached from responsible lending. A modern mortgage closing can make the process appear routine. There is the down payment, the interest rate, the monthly schedule, and a date decades in the future when the final balance reaches zero. Behind those documents stands a century of crisis and experimentation. Before the 1930s, a buyer often needed half the price in cash and still faced a balloon payment after only a few years. After the Depression, federal policy turned that unstable arrangement into a predictable path toward ownership. The 30-year mortgage is not a natural law. It is a political and financial invention created because the previous system failed so completely that leaving housing to the old rules was no longer possible. Its endurance is one of the most consequential achievements of American economic policy. Its flaws are equally consequential. Understanding both is essential, because the mortgage does more than determine how a house is purchased. It determines who can enter the property-owning economy, who can build equity, who can pass wealth forward, and who remains outside the system. The question has never been only whether Americans can borrow for 30 years. It is who receives that opportunity, under what terms, and at whose risk.